Good morning, guys. This is my first video back after my ski trip. So if you haven't seen the ski video, I'll stick a link to that now in the description below and I'll put it into the little box above. But in essence, I guess part of the reason that I've personally been a bit more quiet recently is that there's not really that much to say that I haven't already said, right? So if you look at my TradingView profile and we go back over the last year realistically, you'll actually see, I suppose, Bitcoin becoming more and more institutionalized. Again, as I've said a million times over, I think if you're looking for what Bitcoin's about to do next, it's already written in the same roadmap. Now, I know for many of you guys, you're looking for short term stuff, which is fine. And it's very doable and plausible in terms of trading this, but you have to realize where we are in the bigger picture, right? Now, it's something that I find really funny when you see these kind of fake gurus. You see these guys that have been trading for 3 weeks, if they've traded at all, especially on a live account. These guys are making more money on their YouTube channels than they are in actual trading terms, right? So you got people like Plan B, this guy, the Moon. These guys are not really traders. You can't be 90 grand wrong as a trader for someone like Plan B. The guy Moon, for me, every tweet was buy the dip, buy the dip, buy the dip. And then all of a sudden it was, oh, I've bought a new car. Well, clearly he's not making that from trading. You can see that if he's bought every dip, we're in a downtrend, right? So you have to realize sometimes these gurus, they are saying what you want to hear rather than what needs to be said. And sometimes a little bit of tough love is actually what's required. So we've spent the last maybe 9 months now not really bearish Bitcoin, but there was no real reason to be bullish. Okay. Now, I'm bullish as a whole. I've been buying Bitcoin since 2011. I really appreciate the technology. I understand the technology in depth. I've been an investor a long time, but I've also been in the technology industry for an awful long time. So I really, truly appreciate the technology and what the technology is potential, or what the potential of the technology, could be in the long run. I think for me, there's a lot of issues still to iron out, whether it's, regulation, even down to, I suppose, the policies from companies like Binance and Coinbase and so on. And then you move into things like gas prices with Ethereum and what's happening in the NFT space at the moment. I think overall, once that kind of starts to flatten out as a curve, I think we'll actually get a lot more momentum longer term. Okay, so for now, it just needs a little bit of common sense and a lot of patience. Okay, so what I'm going to do, I'm going to go through first of all, before going into where we go next. I'm actually going to go into what I've said a little bit more kind of in depth, I guess. Okay, so this one, if you just want to skip forward to where we go in next, then fine. But I think if you really want to learn and understand this, then I think it's probably worth you watching the next couple of minutes as to why I think we're doing what we're doing and what backs up what I've actually said over the last year. Okay, so let's start off first. Now, I've recently just tweeted or retweeted a tweet by Peter Schiff. It basically said, Grayscale is actually offering a discount at the moment again. Now, if the institutional buyers were wanting to jump into this, don't you think they would be buying, you know, I think it was something like 75 cents on the dollar, which is actually the way that he worded the tweet. But in essence, you're talking about a 20% plus in terms of a discount rate. Now, if you're a large institutional buyer with millions of pounds to spend, you could easily put, a chunk of capital into the Grayscale fund and be done with it, right? Decent discount and off you go. Now, I shared this back in November. You'll actually see this is the leverage funds, and actually the blue is the selling off right now. A lot of people said to me, and again, this is something that I've mentioned in several streams. A lot of people said to me, look at this, these are the big institutions getting wrecked. They've missed the point entirely. You see this move up here from the 60 odd K level up to where we are now. All this means is that all the retail traders buying were buying premium prices off these guys that have bought way back when. Okay, now I've highlighted this over and over and over again. So that's the first thing, right? We've got COT is still favoring the big boys selling right now. That's backed up with the grayscale discount, etc., etc., etc. Right. So for me, there's no urgency on this particular move up. Right now, going back to March last year, I'd actually written a post called The Roadmap. Now, the roadmap was on the back of another post called The Rocket. And I was actually explaining why we were, from an Elliott wave perspective, why we were looking for the drop. So, looking for the drop there, obviously, then the rise there, where we were looking for the reaccumulation and why that wasn't interesting for me at the time. And this particular post on the 8th of November was just an updated version of that first post. Okay, so you'll see from March the 18th, we actually dropped down, as I was expecting, 4 to 5, the 5 being weekly, that weekly being then a monthly 3, right? So it's done actually no different to what I was saying back in March last year. Okay, so I've actually gone and spent the time to put some educational content, things like Wyckoff, some Elliott, and I'll come into some more of that in a second. Again, I'll put all these links to each of the posts in the description below. But in essence, what we were seeing back then, for me, I seen this as early as February, and seeing the distribution coming into play because of where we were extension wise for the Elliott wave moves. Okay, so call this call, we've seen the same thing. And what I find personally interesting is over the last year, I've actually seen, I suppose, the instrument become more professionalized, more institutionalized as a whole. And that's something that is exciting. It's very interesting to watch firsthand. This is the first time I've seen something like this. For me, I'm not old enough to have seen this kind of happen with gold and silver and so on. But in essence, to see this in a new market, it's incredible. So, going back to September, I was looking at the levels. Now, this was ultimately where exploration phase really for Bitcoin was looking at a potential top to this gray level here. Right now, you can see the date, the 30th of September. Now, there's a couple of reasons, and we teach this within the Discord channel. There's a couple of reasons why I was looking for that being the high. And as you can see, nearly a month later, we actually come up, we tag the high, and we actually then reject off that high. Okay. So overall, you can see why and how this is becoming more professionalized as an instrument, as a tool. But I suppose, like the Peter Schiff tweet this morning, it doesn't necessarily mean that institutional players coming in equals price drives up, right? So that's the first thing. So I've covered this, right? So again, I'll put this one into the link now. And then the next one we've actually got on the mastery call. So again, this is another post, December the 28th, just after Christmas. I'd actually posted just a few other little nuggets kind of in here. Now, you see even from Ethereum, the same things happened. We've seen the drop down 4, we've seen the move up, 5. That really was the weekly 5, so comparable to Bitcoin as a whole. That was called, I don't even know when, back probably April, May time, I'm guessing. We then come into August. Now, part of the reason I've covered this again loads and loads, this particular post was from the 24th of August 21. And what I was actually looking at in this move, the reason that I personally didn't like the 3, the 4, the 5 was we had this really ugly 0 to 1. We had what I would regard as a 5-wave move, although the software was calling 3. I personally didn't like the fact that we had another little move inside there, giving me my first A, B, I would say C, D, and E, and therefore giving me a 5-wave move personally. Okay, now that was just preference for me. And what I'd actually put on there was, if we were correct in what I was calling back there, we'd see the price attract a lot of buyers in at the 65K, which would have taken out the previous all-time high. At that stage, you would want the price to be massively impulsive through that 65K level. It just wasn't. So what I'd said is we likely to go up to the 65K, run just a little bit over, which would be kind of collecting liquidity for the big boys, this would be attracting more and more buyers in terms of retail. And then we'd likely to see 40K very quick, right? Now, what we actually saw was the price come up. We had the 65K level. We went a little bit high, which was the fake out, and we dropped back down. And what did I say? 40K pretty quick, right? That was the first move. Um, we've stayed around this area, which is basically the value area, kind of over and over again. Okay, so right now, that's where we are. That's what we're doing, and this is part of obviously the bigger picture, and this is the mindset around understanding the big picture. Okay, so I then put another post out, which was early on in December as we kind of built up into Christmas. And I basically covered what I've said over the last year. And again, I've covered this in the last couple of streams, why we've actually, gone in and kind of pegged ourselves to things like SPX, Euro Gold, the dollar, and what this actually means in terms of Bitcoin. So again, each of these posts within the posts are actually clickable. You can click through and go into the individual posts, kind of on this. In January, I was talking about, this is January last year, I was talking about the reaccumulation. You can see the price there was around the 32K level. Why I was talking about reaccumulation, what the possibilities were for both A and B, as in highly probable for A and B options, why the value area was down at around the 36K, and why I was expecting then the price to come back to the 36K before actually going up to all-time high kind of territory. Now, this one then was the rocket one, so this was the 18th of March. And again, you'll see, what I was kind of expecting was the price to come on down to create the 5-wave move down based on the back of this being an expanded flat move. And I'd actually used a 8-hour block there rather than a daily block, which actually meant it was $2,500 over the high just before B. But what you'd actually see was the C level I was expecting was actually pulled up there, which is comparable to the move from the low to the high of this year. So in essence, it was just the offset of the block, which allowed us then to take it all down to the 28K level that we were actually forecasting. So it was only the waves within the wave that actually made any difference to the move itself. Now, for me, the fact that we'd actually then moved up and come back to kind of key levels, you'll see, a lot of volume sitting in the zone, the 2 lines that I've drawn there. It just didn't feel inviting enough. Right now, we've got a potential liquidity pot down around 19K. And for me, when we were looking at the move around 44K, a move for a potential upside of 60, for a downside of 19, didn't really make sense when we were talking 15K to the upside and 25K, or more to the downside. And therefore, it just wasn't a decent enough risk reward ratio to say, hey, I want to trade this back up. So I sat on my hands throughout this move and just kind of commentated kind of from the sidelines, really, and just emphasized why I was looking for that move to go up where it was, why we rejected and where I was expecting that rejection to come from. So, you'll see I just covered this in the previous post, why it was there, what it was there. All of the logic is actually baked into these posts. Okay, so you can click on all of these and just follow on through, follow on up. Now, what I then done was for the new year, I actually put the year-end post as a full breakdown of all of the education through 2021. And this was just to show, what people are looking for. Now, this covers everything from the real basics, like, a trend line, moving averages, all the way down into how to buy the dip, why people invest in altcoins. If you want to invest in altcoins, this is how you go about assessing them. I've then covered things like the Dow theory, which encompasses Elliott wave, Wyckoff, some Gann, other little bits and pieces. I've gone into a little bit of depth in Fibonacci. So this particular post has got so much education kind of in one spot. It's definitely worth you kind of clicking through some of these, books to read. There's everything in this, right? This is a massive, massive post. And like I said, every single post is a post within a post. So you'll be able to go through all of this and pick up a lot of education, obviously on the TradingView platform. So I've covered all of that. Now, again, going back to reiterate why I've said right at the start, it's it's not as easy as saying, let's give a call on Bitcoin. Let's say, this is what it is by that time. The guys who have people like Plan B, you can't call 135 grand in December and be $89,000 out in December at the close. That's not trading, that's guessing, that's gambling. Clearly the model doesn't work. And yet, there's a million plus followers following this guy because he's saying, Bitcoin to the moon. And that's all retail traders currently want. The reason most of them want it is because they're in dead end jobs, and the biggest challenge of all is they want something that will not only change their life, they want something to show that they can do this. They can trade. They've told their friends they've bought Bitcoin. So, you just have to be realistic. A lot of these people are actually underwater right now. I've seen posts of, other kind of gurus, they're 70% down in their account. 1 or 2% risk management is what you should be doing as a professional trader. Anything else is just pure gambling. Okay, so what else have we got? So, again, a lot of these posts, I've really tried to just spend a bit of time and emphasize, how simple some of this can be when you know what you're looking for. And I think although many people don't want, what's this doing in the future, they want what's this doing this afternoon. That's really where the problem comes in. When you're trying to take, multiple trades every hour, multiple trades every day, you're more likely to lose because that's what the market is there to do. It's there to take your money. Okay. So if you want to earn more, you actually need to do less, which is so counterintuitive for many people. But it really is what this boils down to. Okay, so just come and have a look through these posts, and you'll see, like I said, so much education, so much content in here that this will give you all of the logic that you're going to need to kind of set you off on that right track. Okay, so what I'm going to do now is I'm going to start now into where we are and why we are where we are, as of now. And then what I'll do then is I'll put this together as where I think we're likely to go next. So first things first, if we look at the big picture and we zoom ourselves out, all I'm seeing right now, it's on a weekly time frame, all I'm seeing right now, big picture, is we've actually come up. We had a 3, we had a 4, and we had a 5. Okay, so that's the weekly picture. Forget the 1, 2, 4 right now. That doesn't matter, right? So what we're looking at right now. In Elliott wave terms, you get the 1, you get a deep pullback 2, you get an impulsive 3, you get a pullback 4, usually around 38 to 50%. And then you actually get a move up, right? Now, on this move up, sometimes you'll see the move up something like this. But sometimes you'll see it where, just like the Bitcoin move, we've come literally just above, which in essence has created what I would regard as a double top bigger picture. Okay, so you'd actually expect that then to drop on down, A, B, and C. Okay, now if you know where we are at the end of a weekly 5, you kind of know that a bigger drop is underway. Okay, now with that bigger drop underway, you're talking about a monthly 3. Okay, so I'm going to put a big monthly 3 in there. Right now, that for me is where I see monthly 3. Now, what you have at this potential monthly 3 is an option for a zigzag, which is quite common. You have flats. Now, I'm not going to go into all the detail of all the different types of flats. There's quite a few of them. You've got triangle type moves. Now, all of these are kind of corrective patterns. And the reason that I personally don't like corrective patterns is that they can be sporadic both ways. They potential, for lots of opportunities within these corrective moves. But when you look at the simple laws of motive waves when it comes to Elliott, these are so much cleaner to trade because there's only a handful of rules to think about. When you look at corrective moves as a whole, you've got multiple versions of the flats. You've got multiple extensions within each of the versions. You've got combo moves being maybe a zigzag plus an additional flat plus an additional zigzag or something else. And therefore, the problem you have is that there's almost too much choice. Okay, so a lot of Elliottians who purely focus on Elliott, they almost confuse themselves based on overcomplicating the matter, right? The situation is just too much. And I understand, right? Everybody wants to find the bottom and sell out at then the tops. The problem being is you're kind of confusing yourself when you're trying to dig too deep, right? There's enough profit to be had, halfway down the move, right? The same thing if you were buying from a two, you could have gone a one, a two in. If you were buying at this level, you could have ridden all of this all the way up. Fibonacci extensions for your exit plans and strategies. Okay, so catching the tops and the bottoms is not really, what you want to be doing. It's kind of more of a fool's game in the big picture. So knowing that we're now at a monthly three, what you'd actually expect, right, is regardless of what comes first, zigzag, flat, triangle, it's irrelevant, okay? You'd be expecting an A, pull back B, and drop down C, right? Now, in terms of extensions, there's nothing to say that what you'd regard as a 0 to A, okay, B only has to be the 618. So that's 0.618, okay, there, 0.618 of the A leg, okay? So if we now assume that we come in and we say, okay, we've had now this A leg, I'm going to go from there and just assume that the low was in. I'm going to come back down. We'd expect a B pullback, okay? And then whatever that B pullback, so I'm going to move this again, wherever that B pullback now comes from, that's the wrong one. So start that. So in essence, oh, it was the right one. So in essence, what we're saying is that if B comes something like this and we come back for a B, we'd be expecting then for the A only having to drop back down to these kinds of levels, right? Which is around, what's that, 44K. So if we get a 50K plus B, it only has to come down, right? So I think the misconception, so many people assume that we have to go deep if this is then a downtrend or a corrective move, right? Now, if you understand where we are and what we're doing within these, we get rid of all of this. This is where it becomes a little bit more complex, right? So I'm not going to go into all of this detail because this is more for the subscribers. But in essence, what I am saying is that once you understand where we are big picture, we've actually gone and done the 3, 4, 5 weekly. That gives us the 3 monthly. And we're only in a situation right now where we're having basically the first leg coming down for an A. Okay. Now this ties in with what we're seeing with the grayscale discount, with what Schiff was saying this morning on a tweet. The reality is the institutional players are not currently buying. These guys are selling off still at the premium, right, to the retail traders who are buying every single dip, right? And this is why retail traders lose, 75% of the time. Now, if we do get a move back up B, like I said, we only have to come down 60 odd percent there to be complete of A, right? So it could be a very small, creating in essence a double bottom. Okay, right? That's the simple terms there. We could go down and create an exact replica of A being 100%. So I'm just going to stick the date and range in. Let's just assume that this is already in. I'm just going to copy this. We go back up. Let's just assume B up at around this level. We'd only have to come back down to 23, 24K, which would, okay, be a little bit deeper. But in essence, that would also be a completion for this zigzag type move. Now, if we were to zoom right in and we look at this first candle on the 18th of December, this first weekly candle there, I'll come into in a daily in a second. But in essence, what you could be seeing is an expanded flat A move, which means we've already hit an extension, which means now B will be the next move anyway. So whether it's a zigzag or whether it's an expanded flat, I think the reality is we still currently sat within the 0 to A on a large time frame. Okay. Now, again, what a lot of people don't understand is that a lot of them will assume that the depth is what's important. The reality is it doesn't have to necessarily be deep. It's all about how to frustrate the retail. The institutional players can sit on their hands for 6 months, 9 months, 12 months, and this not be a stress to them. Okay, right now they're profit taking from way back when. They're offering funds at discount prices to new investors with a view of bringing in the new bag holders, I guess. And ultimately, if we now see a move back up from these kinds of lows, you're going to get the retail traders again buying the dip. And what you're likely to see is the move up B will come back and take some liquidity. So there's a little bit of liquidity sitting around the 52. There's more around 57. I probably personally would say 48, 49, and then potentially back down under the new current low. So we're going to go, I'd like to say 36, which is no different to what I said back in March. You know, when you look at the monthly calls, I'm just going to go the roadmap update. When you look at that monthly call, you know, all I was looking for is the move back down here, 3, 4. And this was only drawn kind of rough in terms of what it was, but the 3, the 4, so this being the 3 monthly and the 4 coming back down into the value area. So, you know, 37 was the value area, 36 was the previous value from January. So in essence, you had 36 to 37 as a range. Even if you widen it, you know, 36 to 38 as a whole, I'm expecting the price to come back into that liquidity zone, kind of collect and go. So I think that would be one of the stop loss hunt in terms of the bigger picture, the bigger move. So I think for me, you know, this is a very long-winded video for what I'm used to. I've tried to cover every aspect of this, and although, you know, there's an element of in the short term, what are we doing? I think for me, short term is, you know, a couple of days rather than a couple of minutes or a couple of hours. I think we still sat within the A, whether it's a zigzag or an expanded flat. I think we're going to get a pop back up B. I think the more I've watched this chart, the more I think this is back to 48, 49 rather than 50 plus. And there's some reasons for that I've explained in Discord again. And then I think we come back down into that value area range. So 38, 36. That could potentially be the bottom. There is still liquidity down at 19. We could get an evil wick, which again is something I've talked about all the way through last year. 23 is another option there. So I think overall, I'd like to see a drop down to 38 within the a push back up to 48, 49 for a B, and then potentially a drop down even as low as 23 for a potential C completion. Now, I might be wrong on the C. I think that could be very, very big in terms of the spread. That could easily go from 19, like I said, with the liquidity. You've got 23, which is a key level. You've actually got just under 28, which was the previous lows here. So again, acting as some big levels. So it could be anything, 19, 23, 28. They would be my 3 kind of main guesses in terms of where we are right now. But I think I'd like to assess that situation when we've actually had the B. So yeah, thanks for watching this one. I hope you enjoyed, and I'll see you on the next stream.